I'm Jeff Lovell, a staff accountant with AA Accounting, and today I want to talk about some of the tax benefits available for saving for retirement. I'm going to focus on the different types of retirement plans, IRAs, and the Savers Credit. There are two major categories of retirement plans: defined benefit plans and defined contribution plans. A typical example of a defined benefit plan is a traditional pension, where your employer pays you in retirement based on some formula that takes into account your wages you earned in the years prior to retiring. Typical examples of defined contribution plans include 401ks and 403bs and IRAs. This video is mainly going to focus on those types of accounts. There are two major types of IRAs, traditional and Roth. Contributions made to a traditional IRA during the year are tax deductible within limits. Distributions from the accounts during retirement are taxed. Traditional IRAs are ideal for taxpayers who believe they'll be in a lower tax bracket in retirement. Any distribution from a traditional IRA prior to turning age 59 and a half is subject to an additional 10% penalty unless you qualify for an exemption. And you're required to begin liquidating the account in the year you turn 70 and a half. Failure to make these required minimum distributions will result in a nasty 50% penalty. Roth IRAs are invested with after-tax funds. In other words, you don't get a tax deduction for contributions made to a Roth IRA, although the amount you can contribute each year to the account is limited. A nice perk of the Roth IRA is that distributions of earnings are not taxable if they're made after the 5-year vesting period. These accounts are ideal for taxpayers who believe they'll be in a higher tax bracket in their golden years. There's no requirement to ever liquidate a Roth IRA, which means these accounts are ideal for folks who don't plan to liquidate them during their lifetimes. The Savers Credit is a non-refundable tax credit for low to moderate income working adults for contributions made to a qualified retirement plan such as an IRA or 401k. To qualify, you must be at least 18 years old, you can't be a full-time student, and you can't be claimed as a dependent on someone else's return. The maximum credit is capped at $2,000 for married filing jointly, or $1,000 for all other filing statuses, and varies based upon your income and your filing status, as you can see in the table below. The important thing to point out here is that anyone, regardless of their filing status, who earns under $18,500 per year for 2016 would get the maximum credit of 50%, and anyone, regardless of their filing status, who earns over $61,500 will get 0. If you have questions regarding this video or other tax or accounting questions, give us a call at AA Accounting. Call us today to set up an appointment to discuss your tax situation with one of our tax experts. We can help.